closing up today doesn't necessarily mean the worst is over. It probably would just mean that people don't want to be too short and maybe lightly long into the Fed meeting. And of course, the Fed meeting can always be disappointing on any level. And even if Fed says everything that the market is hoping that they say, we're staying dovish, we're going to continue bond buying, yada, 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 it could actually mean that the market doesn't care anymore about that. And that's also partly because even the Fed themselves have sort of had a tainted reputation week with finding out that Fed members are trading, although we don't know yet if what they're doing is illegal in the time frame. But in terms of the other, if we go down, are we going to be going down more? Same thing. We don't know what's going to happen out of the Fed meeting and what happens if they decide to be even more accommodative than what we expect, or tapers put onto the shelf. Then we could see that dip tomorrow, one more day being the real buy opportunity. So the bottom line is this: today really doesn't tell us very much as far as I can see. We're in caution phases in pretty much every index except for the Russells, the small caps. There we're in a distribution phase, which means cash is actually being distributed out of the index into cash and more safety plays. And at this point now, I think we have to be a little bit more patient and see what happens here, even with the debt ceiling, because I think that's our biggest risk. Evergrande turned out to be a straw in the camel's back yesterday, but it's the debt ceiling that I have my eyes on. And right now, as we know, the Republicans are saying they're not going to raise. The Democrats say we have to raise. This happened in 2011. They didn't raise. U.S. got a downgrade. Market dropped 30%. And guess what? Debt ceiling got raised. So it's an unfortunate game that could affect a lot of people and their portfolios, but it's a game nonetheless that looks like it's going to be played. In terms of Morgan Stanley's statement, I think the key takeaway from that statement is not necessarily predicting how much percentage drop we can get, but the idea that valuations are really high. And that is true. And a lot of it had to do with a very robust earnings season last quarter. Now we're going to be starting the next earnings season and may not be necessarily as robust, for the obvious reason, number one, being the variant, but number two, being just sort of the economic slowdown we're seeing all around, with what's the prospect for making this economy grow right now. So I think that's the biggest question, and I'm not trying to be negative to support the other side. Do I see new highs? No, but what I'm really seeing more is kind of like in the middle, is a range-bound market. So we haven't even reached our July lows, and we're in the end of September. So it's only 3 months later, and everybody's trying to make these massive predictions. But what if we just go down a little further to our July lows, or maybe break that a little bit and then start coming up? And then what happens if we get closer to what we saw as our most recent highs, particularly in NASDAQ and the spiders? Can they go higher than that? Well, again, we're going to have to see some impetus from that. And the types of things you want to see is inflation cooling, interest rates stay low. You want to see some kind of level of growth. You want to see the labor market come back, and you want to see this variant be put to bed. And until all those things happen, right now, we are the lightest in our portfolio that we have been since before the pandemic. Like right before the pandemic, I saw similar types of signs, with one difference: the junk bonds are still hanging on for dear life, and that's a risk-on environment. We're still seeing that. But if the junk bonds give it up, I think that we're going to see another dip. And I would like to not say, oh, if it gets to this level, let's buy it. But I would be looking for somewhere maybe around 42,000 in the S&P as the potential buy opportunity area. I don't think we're crashing, and I don't think we're going into a recession. But in terms of what to do right now, I think you have to have a little bit of patience, particularly on the heels of a Fed meeting coming up this week. And if we can get back over the 50-day moving average, let's say in the S&P 500, get back more into a bullish phase, you got to heed what a caution phase means. It means caution. So it's okay to be a little bit in cash right now and then be agile when things set up with much better risks. And that's exactly what our game plan is right here. Well, I think what we found out in the last couple of days is that cryptocurrencies are highly speculative. And when you get into an environment like we saw, where you have a deep dive in the stock market, then the volatility in the cryptocurrencies, in the speculative aspect of the cryptocurrencies, responds in kind. So the relationship that people thought where you buy cryptos when things are going bad, we saw yesterday that that's not necessarily the case. And I think these relationships will still continue to work out. Like it used to be, well, if gold goes up, crypto goes down, and if crypto goes up, gold goes down. Well, that could be, and we're studying all these relationships, by the way, to see what kind of patterns emerge. But for now, you've got Gensler talking too. So let's add that. And Gensler, as we know, as most politicians seem to be the only people who want to regulate the space more, who think that it's a speculative bubble, et cetera, and that's putting some pressure. But we still believe that if crypto, particularly Bitcoin, holds above this 4042, that's a good sign. If Ethereum holds above 3,000, that's a good sign. And so we're aside right now in those, but nonetheless, I do believe that if they hold and we can start to see them go back up, then we have another new base to trade off of, and I would go right back in. Unless, of course, the market crashes and we continue to see pressure from a liquidity crisis, then probably I'd stand aside. Well, if it holds the 40,000, I think when you have a situation where you can get into something like Bitcoin with a limited amount of risk, then if you're not in it, it could very well be a right opportunity. And of course, there are other ways now to be able to trade the space without exposure to the coin itself. And that's looking at some of the mining companies that have also gotten pretty beaten up lately. There's a new ETF that just got put out today called CRPT, which in its basket has stocks like Riot, has coin, has a few exposures to the currency itself, and then the companies that are dealing with the currency, like MicroStrategy being another one. So you can find ways to get involved if you've never done it before. But as I always say, you just have to make sure you understand the risk. And if you're coming off of a deep correction, whatever that most recent low is should be your floor. Because as we know, things can change rapidly and you don't want to get caught. You just get out quickly and that's that. But don't be dismayed because you'll get another opportunity.